Everybody, this is Ace Woods and I'm here with Jim Black from Revest Homes, and we're here today to talk about the CalHFA Dream for All program that just rolled out, and I'm super excited to hear about it from you today, Jim. I know you know a ton more about this program than I do, and a lot of people, including myself, have questions, and hopefully we can get a really good overview about what exactly this program is and who it's going to benefit.
Sure. Well, thanks for having me on today, and I want to share the CalHFA program. It's a California program that is basically set up to help first-time homebuyers in the state of California that are looking to buy an owner-occupied primary residence loan, and they are new first-time homebuyers if they have not owned a property in the past 3 years.
Okay.
And that's really important to be aware of, is that most people would think they don't qualify if they owned a house 5 years ago, but they can. So that's the first element to being a first-time home buyer with this great program called the basically Dream for All Shared Appreciation Loan. And what that does is gives our clients 20% of the purchase price or down payment as a deferred payment with no payment, and they get to share on the appreciation of that same loan amount percentage when they go to sell or refinance their home.
So hold on a second. It's the state of California that shares in on the appreciation, right?
That is correct.
Okay.
So this is a state-run program, and it's grants, and it's actually $300 million of grant money. It's a first-come, first-served basis, and what that means is you can secure a loan through an approved lender like ourselves once you've gotten into contract on a purchase. So unfortunately, people may think that they are qualifying for this, but it's really once you're in contract. So it's really important to work with a local professional, both from a real estate and lending perspective, to know that each county has different limits, and those limits are derived by the income limits for each county.
Okay, so each county has its own income limits that you need to be under in order to qualify for this grant.
That's correct.
So what's the Santa Cruz County, Santa Cruz, Monterey, Santa Clara, give me a couple examples of what kind of income limits we're talking about here.
Sure, absolutely. So we're here in the Bay Area. Revest Homes is based out of the Santa Cruz County, in Monterey and Santa Clara County area. So in Santa Cruz County, you can make an average income of $236,000.
Nice.
That's a big number, and that allows someone to qualify really up to about a $1.1 to $1.2 million purchase price with this 20% shared appreciation, no payment loan that can be outstanding for the life of the first loan period of time.
Okay, and so what's like Monterey and Santa Clara income limits?
Sure, there's a big difference between Santa Clara and Monterey County.
Okay.
So Santa Clara County has a $300,000 median income amount. And in Monterey County, it's $178,000.
Oh, wow, that's a big delta.
Yes, and there could be actually conventional loan limits differences in those counties also.
I was going to bring that up. So not only is there an income limit, this is considered a conventional loan, right?
Correct.
So there's also the conventional loan limits that differ county to county.
That's correct.
In a similar way.
That's correct. So we could be in a situation where we have to be really careful if we're looking, for example, in San Jose or Santa Cruz, California. We may want to make sure we understand the limits of both loan size and income limits, because that could be skewed either way in a good or bad way for our first-time home buyers. The other element to this loan is it's a conventional loan. Conventional loans, less than 80%, don't have mortgage insurance.
Awesome.
So that should be another helpful tool for people that may have thought that they had to pay mortgage insurance and that no longer applies, which is also a really good thing.
Can you give a really quick explanation about mortgage insurance?
Sure. Mortgage insurance is basically an insurance policy that the homeowner pays to make sure that the lender is covered in case of default or foreclosure. So it's extra money wasted. It's also not tax deductible like mortgage interest or origination points can be. So it's important to be aware that it's an extra junk fee that you want to avoid if you can.
Great.
What about, what do you see in ACE right now with a lot of people out there looking to buy a home? What are some of the challenges people have? Is it saving up enough money for their perceived 20% down payment? Are they?
Well, yeah, that's exactly what it is. And this is a big educational point that I try to bring up a lot is you don't need 20% down to buy a house. At least you do if you want to avoid the PMI and the mortgage insurance, but you can buy a conventional home, a home with a conventional loan for as low as 5% down, right? So that's still kind of a large amount. I mean, that's $50,000 on a $1 million property. It's not nothing, but it's accessible. But most people are thinking this 20% number. And of course, the higher amount you have down, the lower your monthly payment's going to be. So it does make a really big difference, I think, for people who may be bringing in couple $100,000 a year, $200,000 a year. They've got great income, but because the cost of living is so high, they're not able to save for that down payment effectively. And this could make a huge, huge difference. The other situation that I'm seeing is in this kind of million, 1.1, 1.2 price range, a lot of the homes are they need help. They're kind of fixers, not like really bad fixers, but they're a little bit dated. It's kind of the entry level price point here in Santa Cruz County. So
and Monterey County and Santa Clara County, right?
So not only are they trying to save for down payment, I'm usually having the conversation, you're going to need some money for repairs. If you're in an unincorporated area on septic as of July 1, you may need to put in a new septic tank, and that could be $50,000 plus alone. So not only are they trying to save for the down payment, they may be also needing to save money for repairs because the homes that they're getting into as their starter home, even at $1 million plus, is still going to need some work on it.
So again, that's a great point. We want to look at opportunity costs when we're doing loan financing for people. The higher the loan to value or the less down payment, normally the more risk plays a role. So a traditional buyer, like you mentioned, with 5% down in the past, that rate was probably much higher than a rate with putting 20% down. And
that's a great interesting point.
Yeah, and what's nice about it all is this 20% down number has no payment, therefore it has no qualifying payment against them. So someone could be being pushed up another 10% more in buying power, which could be $100,000 more. It could be $150,000 more in buying power. And there are trade-offs, right? We always want to look at the differences between doing this program and maybe bringing the 20% down instead from a gift or from another source. And that big difference to think about is the shared appreciation element.
Right.
So if I'm keeping a loan for 30 years, if I'm never going to refinance again, this product might not be the right product for me because every 7 to 8 years, if you think about the laws of inflation and some of the rules around your money doubling every 7 to 8 years, you'd be losing a lot of your equity or in the shared appreciation realm. But if you have a short-term goal, or if you think interest rates are going to go lower in the next year to 2 years, then this is a great program because you're only getting shared appreciation off of the appraisal or sales price of your home when you go to do that. And it's based on the original note amount, not based on how much you've paid down the loan.
That's great. So you're not paying 20% to the state based on your equity that you've gained, just on the appreciation. So if you're paying down that if you're there for 15 years and you pay down that primary
principal and interest loan, yep.
You pay that down a lot. You're not giving 20% on that. You're only paying 20% on the delta between the original note and then the final sales price less any realtor fees.
Exactly.
That's great.
So that's important to be aware of. And one other caveat about this program, which is really important to be aware of, there is a low income qualifier. If you're less than 80% of the average median income or AMI in that specific county you're looking at, the forgivable, or I should say the appreciation percentage shared is only 15%
That's
versus
great.
20%. So California is trying their best to help families that are in a lower to moderate income amount be able to push to higher loan limits to be able to qualify for more and help people that pay tax, that have jobs, have important roles in our community with the dream of home ownership. So that's an important element. And a lot of people are going to get excited about this product. They're going to reach out and try to get involved right away until they understand this product. They really need to know that you have to go through homeownership class, which is a really good class, normally about an 8-hour class that shares a process of buying a home, which is awesome. And also, again, we always want to look at other alternatives besides just one loan when we're looking at properties. Mm-hmm. Sometimes a property might be needing a lot more work than a conventional loan can supply. So maybe we do a renovation loan, or maybe there is a better loan program that exists and there are certain criteria that someone needs to qualify for, There are FICO score requirements that are a little bit higher than the normal, but either way, it's a great way of making sure that you know before you owe, the choices you can make to make sure your family is in a good position. And
before you go any further, what is
yeah.
that FICO score that we should be keeping in mind in order to qualify?
660 is a score. 660 is the normal score we look at, and there's pricing differences sometimes with different loan programs. The higher the credit score, the more likely you are to get a better interest rate and better options, because it's all based upon the history of you borrowing money.
Makes sense.
I'd like to share an example of a purchase price to give you guys an idea on a payment. I'm a licensed loan officer professional, so I can talk about this stuff. Let's use an example of $1 million purchase price. That borrower wants to use the 20% shared appreciation loan. So we're looking at an $800,000 loan that's going to have a principal and interest payment. And we need to calculate that with the principal and interest payment on the first loan, property taxes, and home insurance.
And there's no payment due on the second loan.
Correct.
That just gets paid back when they sell. Okay.
Yep.
On the $200,000.
Exactly.
Okay.
And in this example, if I was to take 20% in a shared appreciation, my payment would be $6,850 total on $1 million purchase. And the income I would need to qualify would be about $15,750 a month of family income.
Which is, what is that a year? Mr.
That qualifies right under, that's right under the limits for Santa Cruz. It's about $186,000. In Monterey County, it would be a little bit too high. So in Monterey County, you'd probably be about $950 purchase price.
Okay.
Santa Clara County, it could be even higher. Again, we're looking at loan limits, income limits, and the debt to income ratio.
Right.
Whatever loan we do, whatever situation we're in, the most important thing is not only is someone qualified for that payment, we got to make sure that they're comfortable with that payment.
Yes.
Too many times people stretch too far, and in this marketplace, we want to make sure you're comfortable and have looked at all the options, both worst case and best case, and what can happen with interest rates. Because we've seen interest rates almost double in the past year and a half. They actually have over doubled. They've almost tripled in the last year and a half. And that every percent difference in rate is a difference of 11% buying power. So if you're looking at $1 million home and rates go down 1%, you can now go to about $1,110,000. So that's a good thing. It can work the other way too, where rates can actually work against you. If they go higher, that qualifying amount of your purchase price goes down. So we want to make sure that we always play it safe, and we're always conservative in our estimates to make sure you know before you owe and make good decisions with your life. What are you excited about this product? What do you see?
I mean, my head's gone in a bunch of different directions on it. Based on what you've said, it seems to me that a really good strategy could be, if you have good income but you're low on your down payment, or if you're buying something where you want to keep your cash on hand to fix it up, it could be a good program to get into. And probably the best strategy would be to refinance as soon as you kind of meet that benchmark of equity, that 20% equity where you can refinance. And then once you refinance into a traditional loan, you're not then paying any of that extra appreciation. So you kind of want to find the sweet spot, it seems like, of refinancing in a couple years once you've gained that 20% appreciation that you would need for your down payment, but not much more than that, right?
Absolutely. Because again, the longer you have your house, the chances are very strong that there will be appreciation. On average, the economy grows between 2.5 and 3.5% year over year. And that's a number that gets you to that compounding appreciation number of about every 7 to 8 years, the value of things doubles. So that's why we want to keep that in mind.
So it can make a huge difference if you get into one of these types of loans and then you don't refinance in a few years. You could end up, giving away a good amount, 20% of your equity, or not your equity, your appreciation.
Yep.
And that's what we always want to make sure that you're able to hold on to. So I love how it gets you in the door, but I think that you need to be, fairly vigilant that in a few years you're going to be ready to get out of this program so that you don't give away more appreciation than you need to.
Absolutely. And just because we can go up to 20% down payment of this shared appreciation doesn't mean you have to. You could do 10% down. You could do 10% on the second shared appreciation and a first loan of 80%.
Okay.
We were the last lender to fund the CalHFA HFA loan last year, which was known as the Builder Forgiveness Program. And that allowed someone to take 10% and actually forgive that loan over a 5-year period of time. So they were able to get
nice.
10% of their funds forgiven over 5 years, as long as they own it. So
That's
they
a
own
nice
it.
program too.
Yeah, that was
Yeah.
great. It no longer exists, and the funds available for that were a lot smaller. But this program, again, has $300 million of money. And let's say the average homeowner is going to take $100,000 of this. If I take $300 million divided by $100,000, that gets me 3,000 borrowers to help. So
It's not
again,
a ton in a state of 18 million people, however many people.
it's not a ton, but there's not a lot of inventory now too. So this works for a purchase loan only. So again, if you're looking for a home, please talk to professionals. We'd love to be a resource for you, but talk to professionals that you know, like, trust, and will do a great job for you, that understand this product. We are approved and licensed to do this product in the state of California. There are a lot of great lenders that do this, so it's not just us, but we'd love the opportunity to help you make a great decision with everything related to financing and real estate. And Ace, any departing words before we get back to fielding all the phone calls about this product?
I want to just maybe run through real quick just some of the bullet points we went over. So 660 credit score.
Yep.
Minimum credit score. Santa Cruz County, 236,000 income limit. Monterey is
178.
178, and Santa Clara's
300, correct.
Okay. If you're putting down 20%, you won't have to do your PMI, but you don't have to take the full 20%. You could take less.
Yep, correct.
You will have to pay back 20% of your appreciation.
And
at the time you
appreciation
sell.
is based on the balance of your notes, not the balance of your loan.
Right.
So if I started with a $400,000 loan on my first loan, that's what it's based off of. It's not based on the fact that maybe I paid down $100,000. It's purely the notes that started and the appreciation from that number.
Great. That's really nice. And then, are there any other points that kind of like takeaways here? that you
Yeah,
wanna add?
the average transaction time frame is a traditional escrow.
Great.
We were lucky, knock on wood, to finish one in 19 days last year
Really?
in the month of November. So it was a really good holiday gift for our
Amazing.
clients.
Yeah.
And we were literally the last loan that funded.
Wow.
We found out that we were the last loan before they ran out of money. Luckily, it had gone through the whole year almost, so that was encouraging. But again, if you're looking to buy a home, please talk to people that you trust, people that are experts in their field, and that give you alternative options and solutions to choose from, because it's not a one-size-fits-all. There may be an option to get a gift from a family member. There may be an option to take the 20% shared appreciation loan. It just depends on what's best for your needs, and we'd love to be a resource for you. And thank you for your time.
Thank you so much for getting together, explaining the nuances of this. It's a little bit complex at first, but it's starting to make sense to me. And I think the short answer is, talk to Jim, talk to your lender, get some information over. They can run through and find the best scenario for you, see if you qualify even. And it's just, I love that this opens the door to a lot of people. We live in a very unaffordable place to live here in the Bay Area. And this really, I think, opens the door to people. So Dream for All, I like the name. Makes sense.
Thank you guys, and we'll see you hopefully sometime soon in escrow, and have a great day.
Thanks, Jim.